finest.
Exactly. Somehow I teleported to Miami today, so that's where we're broadcasting live and direct from Miami.
Do you want to explain the experience you had? We'll kill a couple minutes here waiting.
Sure. Yeah, I mean, thanks everybody for trickling in and being on time. Like I said, we'll get started in just a minute, and this is recorded. But the reason why I'm in Miami to begin with is because I've been on a car rally this whole week. So I've been driving with a bunch of maniacs from Knoxville through the mountains all the way into North Carolina, down to Georgia and Atlanta. We went to the Atlanta Motorsports Park, which is a beautiful racetrack. It's very much a technical track, not a speed track. So top speeds weren't really a thing, but the corners sure were. So I learned a lot from the instructors and had a blast there driving a GT3 for those who know. And now I find myself here at the end of the trip, Miami, ready to get back home to New York and resume my regular life.
Yes, yes. Well, the cool thing about that is we've got wonderful friends that also are investors, and sometimes investors become, really good and meaningful friends. So it was really cool that our investor graced you with the invitation to
Yeah,
allow
that's
you to come. I
yeah,
mean,
that's
what's
the part
better in
I
life? Yeah.
yeah, I totally left that part out. I mean, how did this happen? It was not my planning. It was a last minute trip where an investor invited me to join. Gave me a car, gave me a great experience. So I'm super grateful for the relationships that this business has built for us along the way and for the many more that I'm sure will come.
So, having said that, you can certainly buy us and bribe us if you're looking to do so. I'm more partial to country clubs and golf courses and that experience. So, if someone wants to invite me to their uh, elite and cool country club, like Cal Club, the shirt I'm wearing, top 100 course in the country, I'm cool with getting invited to all sorts of places. I will fly to you. So, rest assured, I'm a good time and I can be your ringer if you're in a member guest for. A potential Calcutta member guest country club tournament. I'm playing terrible golf right now, but I'm sure I'll find it soon.
You'll have fun either way. All right, well, and we're gonna have fun on this webinar, so why don't we go ahead and get started?
Yeah, so the purpose of this webinar is super cool, and let's just introduce ourselves real quick. My name is Craig McGrother. I'm fortunate enough to be the Director of Business Development with LSCRE. I'm also going to caveat and say this for those who maybe been listening to this for a long time. You might know a bit of my story. I might sprinkle in here or there, but I'm actually a son of a very, very successful financial advisor. And I say that because that does kind of mirror what we're talking about today, which is how is multifamily going to fit into your portfolio and your investing, right? Or maybe just real estate at whole. I've been fortunate enough to be the director of business development at the firm for almost 4 years now, and I've been in real estate for just shy 2 months. It will be a decade-long real estate experience. I started work June 21 in the working world, so very proud to state that, but also caveating it with kind of the education background that I had regarding just overall finances and investing, as that was something that my dad and I still. Maybe my dad just chirps at me saying I need to make more retirement and stock market contributions, but we'll get into that today.
Yeah, that sounds good. And so I think, just to reiterate the theme of the webinar, it is how multifamily fits in your overall portfolio. And I think this is an opportunity to take a step back because myself, Craig, and I'm sure many of you on this call as well are more gravitated towards private real estate investments, and that's great. And being focused is great. I think, focus is a big pillar of our success at LSCRE. The fact that we're focused on, one particular state, the fact that we're focused on, a particular strategy and a subset of the multifamily business. We're not running around doing development. We're not doing, retail or hospitality. And that allows us to be experts. That allows us to vertically integrate and find more ways to create more value. So focus is a big, big thing. But as an investor, there's this thing called diversification, and that is actually definitionally the opposite of focus. So it is all about finding that right balance. So today we're taking a step back and saying, yes, we love multifamily. That's what we do every day. But we recognize that we're not your tool for your entire portfolio. If someone came to us and said, we want to give you all of our money, we would probably say, well, we're flattered, but that's probably not the right thing for you to do because there is such thing as portfolio construction. There is such thing as having a thoughtful allocation across different strategies and exposures. So that's what we're going to get into today. If you have any preemptive thoughts, questions that are burning or that you want to make sure the conversation is steered in that direction, please let's make this interactive. Go ahead and just get going in the chat. Let's fire up the chats. Let's have a conversation. Let's introduce ourselves. And then you can also utilize the Q&A feature or the raise your hand feature or all the other Zoom features available to us these days. Okay, cool. Well, without further ado, just to jump right into things, when we're talking about portfolio construction, I think the big thing, kind of the elephant in the room that some of us are excited to talk about, some of us may not be as excited to talk about, is the stock market, right? And that's public equities. And public equities are one of the primary wealth drivers in the country. I would say take outside of your single family home, your primary residence, right? Stock market's kind of that go-to big pillar of someone's investment portfolio. And I don't think that's a bad thing. So I think Craig will share more about overall philosophies about the stock market and how it relates into your broader portfolio and how it complements actually multifamily as well.
Yeah, absolutely. So the way I look at the stock market and the way I have kind of viewed it is I'm not someone who is looking to get rich overnight. I'm not someone who is going out there and saying, "Oh wow, well Tesla looks like a great buy today, so I'm going to buy Tesla," and then get in and out of it or something like that, right? So how I like to look at, my stock market allocations, my contributions that I make there is really a set it and forget it model, right? Now, would I be more interested in the stock world of things if I could 1031 stock to stock, meaning if I could buy Apple shares today and then exchange them into Google? Well, yeah, that would probably drive a lot of alpha, right? But the way I look at the S&P 500 or the index funds that I'm in for stuff is I want to set it and forget it. So what does that mean? I want to put that dollar in and then really honestly never sell really anything moving forward unless I have a tax incentive or a way to, manipulate it in a sense utilizing a 1031 exchange, or if it's a primary residence taking out that $250,000 if you're a single person doing taxes, or if you're a married couple, $500,000 of a gain tax free. So with that said, I'm looking at this equation as to I don't want to have all my dollars in one avenue. It would be really foolish for me to have all my dollars in my home, just like it'd be really foolish to have all my dollars probably with LSCRE, although there's a high concentration there. And then it'd probably also be slightly silly as well to have all my money in, let's just say, the S&P 500 for simple terms. And for those who don't know what that is, that's basically the market taking the 500 most valuable companies and giving you exposure equally into every single one, right? So you don't have to think about it much, and it's dynamic. So let's say a company is humming, it's the 100th, highest valued company, and it falls to, 600, then that gets out of that bucket there, and it does all that hard work for you, which is super cool. So it's an incredible vehicle, but the way I look at this is not a in and out play. I'm thinking this as I put this dollar away and I literally never want to sell it. The way I treat it is this will be hopefully my great grandkids' money, or, at my parting from this earth, it will be, reset and they will do with the funds as they find best. Hopefully, they have a nice financial background where they put it in smart places and aren't blowing it somewhere across the country or doing something silly with that money, like buying a supercar, right? So, with that said, I look at those dollars as a tool to park and to never think about it, right? And I think that's probably the better long-term aspect to have on it because getting in and out of stuff, in my opinion, that's above my pay grade. And it's also something I'm not super knowledgeable in. I don't think and wake up every day looking at charts, reading the Wall Street Journal or a Financial Times article. I'm really just, hey, I know what I know, which is, homes, and I know multifamily real estate. So that's something that I probably actively put more time and interest stuff in because I'm, A, I have more control of that, but B, I have a better insight into it. And then there's that bucket and allocation, like that stock bond stuff that my dad and my advisors on that end, fully manage and cover for me.
So one of the best things you mentioned is about the SP 500 index. And so the little tidbit that you gave is a huge actual insight. And that is that the SP 500 index, so if you buy, VOO, which is Vanguard's SP 500 index, or if you buy SPY, these give you an exposure to those biggest 500 companies in the world. And if a company goes out of business, or just gets out of the 500 and a new company joins the 500, that auto rebalances without any tax consequence because that's activity happening inside of the ETF. And so you, as the ETF investor, when you buy that ETF, you don't suffer tax consequences associated with that rebalancing. That is almost as if your index fund is doing 1031 exchanges and constantly upgrading for the best companies, the companies that are getting bigger, the companies that are growing. And so it's very unlikely that you're going to just see the entire stock market, go to zero. Whereas if you were to put your money into one single stock or into one single multifamily syndication or otherwise, that could in fact go to zero, which unfortunately people are seeing happen these days, and they are chastened by that experience, and now they're looking to solve for a better way to go about things. So that's a huge insight. And so the other thing I want to just take a step back and say is that from everything you heard about from what Craig said there, there was no vitriol, there was no bias, animus, right? I think it's a very big mistake when private multifamily or any sort of real estate syndicators and investors, when they poo-poo the stock market and they say the stock market is volatile and you want to get out of that volatility and you want to get into the nice, comfortable, cozy multifamily
As
syndication.
if that's not volatile itself, right? It's really silly. Could not agree more. And we speak with a lot of folks right now that are in our space that are investors, right? A lot of times they're tech employees, perhaps. There's a very massive concentration of where investors come from. It's mostly four states. It's California, it's Texas, it's Florida, it's New York. So let's just call it that Bay Area bucket of investors, right? Well, what's the primary sector in the Bay Area? It's obviously tech. So a lot of these employees, maybe work at a Meta, maybe work at a Google or whatever the company may be, right? And they've got a lot of exposure and concentration into, their stock plans, stuff like that. And oftentimes they ask, hey, I'm looking to diversify. And I say, it's great. I wouldn't consider something like this as it's not a this or it's this and. So stuff like that we're doing for a lot of people, wisely so, is supplemental ways for them to grow their money and also not have the exposure only to public markets, which is super cool.
Yes. So with all that being said, though, there are pros and cons. And there's also that those pros and cons are dynamic. They're dynamically changing. And I think one really massive insight, if you were to take away one thing from today, is actually what is happening today in the private markets versus the public markets, specific to real estate as well. So if we just look at a very simple metric. I'm just sharing my screen now. If we just look at S&P 500 index price, we can see that there was if I zoom in, this is a 5-year chart, but if I zoom in on a 6-month chart, you can see that there was a correction here. So we traded down about 8%, that is a nice correction, but it's actually not a bear market. Bear market people consider once there's a drop of 20%. And then, funny enough, we actually recovered fully. So we actually went up 12.5%. So we recovered fully and now we're back. So, and people love to consider, why did the market go down? How is the market reacting? What information, what data, what news? This, most would agree, this is inflationary shocks and recession fears associated with the war in Iran. And that's what caused the market to go down. And then evidently the stock market, right, which is the most competitive game in the world, the brightest minds all around the world are all putting their money. Money is a vote, and they're voting behind what they think, right? So they're putting their money where their mouth is. So basically the world is saying, yeah, we don't think this war is that big of a problem. We think that all the pros or all the positive news outweighs the negative news. What's the positive news? Well, maybe it's enhanced productivity from AI. It's, maybe inflation going down is not a concern after all. Or maybe it's that, the Trump administration has a handle on the situation and that we're not going to spiral out into World War III. That's what this chart is telling you effectively if you're to read the tea leaves.
And, it's also kind of been in vogue, and it's certainly, a very real thing going on right now, is there's going to be probably for the first time in, I don't know, Rob, how many years, there might be a very robust IPO market coming up from a lot of these private companies going public, most notably, obviously, SpaceX and such like that. A lot of other AI companies, that's probably being baked in and priced into this right now because there are rumblings that a lot of companies will, in fact, go public.
Yeah, I mean, that's another, maybe can of worms or something, but the who knows what the answers are, and we're not here to really say what those answers are. But what if we can clearly see here, whether it's a 6 month chart, a year chart, or a 5 year chart, is that effectively the stock market is at all-time highs. And the stock market's valuation, which in this case, today it's 7,100, whatever that means, right? The exact number doesn't matter necessarily, but what that valuation is comprised of is two factors. And this is going to sound very familiar to real estate investors because there's also, similarly in commercial real estate, two factors that drive valuation in that market. So for the stock market, the two factors would be essentially the earnings and then what the multiple of that earnings is. And there's different ways to reflect it. Some people refer to, EBITDA, and then there's a PE ratio and all sorts of different things, right? But it's very simple. It's kind of like a universal analysis, just like in real estate, you have an NOI and you have a cap rate, right? So basically, there's how much income the thing makes, and then at what multiple is that income worth? And so in the stock market, the reason why we have all-time highs is because income for all these companies, right? Think Apple, think Microsoft, think Google, the income of those companies continues to grow because they're selling more widgets, there's, inflation, so they're raising their prices and more people are buying. And then at the same time, the reason why the stock market valuations are going up are because the multiple with which that income is being valued is going up. And so basically when multiples go up, when basically people are willing to pay more for the same income that a company produces, the the inference there is that people think that that income is durable, there's lower risk, and they think that income is growing. And they also think that, it's also based on interest rates. So there's a correlation to interest rates where if I can only get 1% at the bank, then I'm willing to pay more for a certain amount of income that a company produces. So that's very oversimplified, but that just sets the stage for me to show you what's next, which is let's dive into the multiples. So if we look at multiples of PE ratio, which is basically a cap rate, and except it's flipped. So in this case, you have the price to earnings ratio as it's reflected as a multiple. So if a company is worth 20 times their earnings, that's effectively a 5% cap rate, right? If you just flip that math around. And so this is the S&P 500's PE ratio going back essentially from the beginning of time. And you can see that there's been periods when it's higher, which basically stocks are more expensive on a per value basis. Forget how much the companies make in income, just per dollar of income. Sometimes the market is more expensive and sometimes the market is cheaper. And this correlates with essentially stock market returns. If you were to buy into the stock market when P ratios are lower, when the market is effectively cheaper, you are likely to perform better. And what we're seeing here is you kind of ignore this period of time because this is noise, this cycle here when things got really skewed because income went down so much. This is actually, funny enough, this period of time here where PE ratios shot up through the sky, it's not because people were paying so much and multiples were going crazy. I mean, by definition, they were, but it was actually more of a income depression. So stock prices were staying somewhat flat as the economy, it was a massive recession, as we
Is the
all know.
GFC, the Great Financial Crisis.
Exactly. So company incomes were tanking and stock prices were going down too, but not as much. And that's where you see this huge spike in PE ratios. But if we take that one spike out, you basically have a couple things that make sense. You have the dot-com bubble where things were crazy and companies were valued very, very highly because they were thought that, oh my gosh, income for these companies, these internet companies, are going to go to the sky. So any price you pay, it's going to be fine because the income will grow into the valuation. And as we all learned, that wasn't true because we saw a crash in incomes plus a contraction in multiples. And that's where you really get hit with a double whammy in price decline is when both factors are working against you. Income's going down and multiples are contracting. That's where you see these massive stock market corrections like we saw in 2001, we saw it in 2008. We saw it here briefly even during COVID, right there. And now we've recovered very nicely, and we're sitting at around a 30 PE ratio. So that's almost like a 3% cap rate for the stock market. That is very, very low. And if you read up on the analysts, the experts, they basically say that historically speaking, and you look back in time, when you buy into the stock market at around this PE ratio of 30, that's around the high mark, right? If you just look at this chart, there's only been a few times in history when it's been this high. You are likely only over a 10-year period to earn around a 2% return per year in the stock market, right? And that's an underperformance relative to what conventional wisdom says, which the stock market should deliver somewhere between, 6 to 10%, depending on who you ask. So the data says that you're almost guaranteed to underperform because you're investing at a near cyclical high. The reason why we are showing you this is not because we think the stock market's bad. We just told you all the good things about it. It's because this is actually a fascinating period because historically, the public markets and the private markets move roughly in tandem. When real estate's expensive, the stock market's also expensive. But what is interesting about today is you've got the S&P 500 at near all-time highs or all-time highs. The PE ratio is very high. But if you look at the private markets, they're telling a completely different story. Craig, you want to share what that story is?
Yeah, well, basically, it's dislocation, right? So essentially, real estate has been really cheap over the last 3 years. So, funny enough, in 2022, if you look back at it, tech had basically a little bit of a recession. That's when rates started going up. And that's also when what else happened? Well, that's when real estate started to get depressed too. Now we're sitting here and real estate pricing is relatively cheap. I would say cap rates at, not the cheapest they've ever been, but rents have been the lowest they've been really because of so much supply coming online, right? So real estate right now is actually really cheap, relatively speaking, compared to how expensive the stock market is. I mean, we just showed you the graph. The stock market right now is at an all-time high, which is really unique. But what we're also going to see is, if you want to go back to that graph, it's awesome. We're about to see historically low levels of supply being delivered right now, which is incredible for those who are getting rent growth and those who are doing existing structures. What's also challenging to kind of forecast right now, if you're a builder, is what are your costs right now? Because land's, maybe a fixed cost, but what's not a fixed cost is your materials and what that would take to build like kind property right now. The deal that we just acquired, Preserva Copper Springs, as an example, we bought that for $163,000 a door. If you were to replicate the exact same structure in the area, you're talking about buying something that might be, 215,000 plus a door to build to make it, of similar quality, right? So that's a pretty large discount we're getting right now. So in essence, what we're kind of painting the picture of is that the stock market, as we saw, is at an all-time high, but real estate prices are not correlated to that right now because they've been so tough right now due to rates obviously going from basically SOFR at zero to probably just low 4% right now. So it's a very fascinating point in time and marketplace where real estate is cheap in relation to where the stock market is.
Investing's never easy. There's never this sure thing, oh, this is such a no-brainer. There's always a bit of a bet, right? I mean, literally by definition, there's a bet, right? You have to take risk in order to achieve the reward, right? Risk-free
And
investing.
investing is all opportunity cost. At the end of the day, it's just, am I going to put my dollar here versus there? What vehicle am I more comfortable in to take it on?
So to break it down further, if you were to look at the stock market, right, the S&P 500 in particular is dominated by the Magnificent Seven, the biggest tech companies in the world, and also it's dominated by AI exposure, and that's what all the growth is. The reason why the market's so high and the reason why the multiple is high is because basically a bet on the stock market today is a bet on the revolution of AI, and that AI is going to massively improve the profits of the companies that comprise the S&P 500, and it's going to, essentially change our economy. And that's not a bet that is, I mean, who knows if that's right or wrong. I wouldn't fault anyone for making that bet, but that is the bet. If you are a buyer of the stock market today, you have to lean into that thesis, and that's the gamble that you're making. Now, what's the gamble that you're making in commercial real estate? The gamble is that prices have come down, as you can see. This is the cycle, right? So this is a completely different chart from the stock market chart because the stock market chart looks like this, up and to the right. If you zoom out far enough, right, there's no wiggles. It's just basically up and to the right. But right here, we're zoomed in on a 5-year chart for US multifamily, and we can see that prices peaked in 2022, and then they've hit a bottom in about 24. And depending on the asset, we're still kind of treading water and near that bottom. So if you believe in the cycle, then this would be the better entry point. But it's not so simple, right? Because why did prices come down in the first place? Well, it's because multifamily is experiencing an unprecedented, a record-setting boom in construction. And here in the chart below, the pricing chart, you can see that as evidenced right here. We had a peak in deliveries in 2024. And so that's when record-setting number of multifamily apartments were constructed, delivered, and leased up. And that massive inflow of supply caused an imbalance of supply and demand. And with that imbalance of supply and demand, you saw a decline in incomes. So, like I mentioned, price is a function of two components, income and then the multiple, or in real estate, the cap rate. And in this case, this price decline that we experienced here from 22, 23, 24 was due in part because of a decline in income because of pressures from supply and demand imbalances, as well as rising or increases in costs from property taxes, insurance, payroll, construction costs, and things like that. Plus, there was also pressure from the cap rate or the multiple side of things because we saw interest rates go up at an unprecedented pace, and that pushed cap rates higher as well, which is said differently, a reduction or a compression in multiples. So I just painted a very dark picture there, and it would require a dark picture to see prices come down this aggressively. And so now you have to ask yourself, well, what's the story that I'm buying into now? That's all that happened. Now, what is coming next? And what's coming next is what you see here as forecasted by CoStar is one, a very, very sharp decline in deliveries. We're going to be going into an undersupply market actually, where we're delivering a historically low amount of apartments. All the while, the country is, bigger than ever. Not to be political, but ICE didn't make a dent in deportations in the grand scheme of things. So the population is growing, demand is growing, supply is shrinking. So CoStar projects and many others that multifamily prices are forecasted to go up quite nicely over the next coming 3, 4, 5 years. And so that is just me personally, that's a story or a thesis that I'm much more comfortable leaning into than I am into the revolutionary changes and essentially the profit enhancement associated with AI. I do believe in it, but I just don't know it as well as I know this chart that I'm looking at right in front of us.
Yeah, it's also important to know supply is not also equally concentrated. So other markets are taking on way more proportionally than others. For instance, Austin, Texas, or a Phoenix, or a Nashville or Charlotte, or some pockets in Florida are examples of wow, there's a lot of supply in those areas, but it's not all equally weighed out. So it's important to find pockets in markets that don't have oversupply concentration or you're not kind of fighting, problems like that, that will obviously hurt your hold period. I mean, there was actually an example of a deal that Rob and the team were looking at where there was a vacant piece of land, if you look at Google Earth, right? And, we kind of did some due diligence on this and we were liking the deal, but then got very uncomfortable when we saw that. And we basically factored in, okay, well, if this does happen, we're going to be fighting like heck over that kind of period when that kind of comes online because there's going to be basically a war for tenants for that area. So we like that deal at X price, but based in that there. So it's important to know how you kind of view supply in your area for when you acquire a deal specifically.
Absolutely. So hopefully that all made sense, and hopefully that is an interesting nugget about how the public markets and the private markets, specifically in real estate, are divergent right now. They typically over a long period move together, but there's always times where they kind of move divergently. And today the divergence is very, very stark. And so it's something that I think is worth considering taking advantage of from a portfolio construction perspective. So if you were previously considering buying more stock, now maybe you would consider, well, instead of buying more stock, maybe I will actually invest into private real estate because I like the entry point and I like the thesis more.
Yeah.
Or
What we're really saying here, in essence, to kind of put a bow on that too, is we're not saying to sell off what you have to go all in on one of our deals or someone else's deals, right? What we are saying is with new dollars that are being created that you're earning, that you're maybe getting liquidity events from, or you get a bonus. Maybe consider the alternative and private markets right now because they've been so beaten up and they are, as we just showed you, relatively cheap.
yeah, that's kind of what I was getting at with basically there's different ways of making moves, right? The most extreme move you could make is sell this, buy that, right? That is a swing trade or what I forget what people call that. But
Yeah, long short.
that yeah, that's a long short. That's a very, you know, that's the most aggressive way you could take a thesis that we just laid out and execute upon it, right? Something that would be more tame would be, okay, I'm actually going to just hold what I have here and then add more over there, right? And so
Yeah,
there's
so
a nice
rebalancing the scale with new contributions in essence.
yeah, so there's a nice gradient for people to allocate, or strategize across. It doesn't have to be black or white, it doesn't have to be all in or all out, and nor should it be, right? So that was, kind of part one that we wanted to touch on. The other piece that we wanted to get into were the tax benefits associated with commercial real estate, specifically what we know best, which is multifamily, and how unique it is in your greater portfolio. Because a lot of investors, and I'm sure, everyone that's listening to this is a most likely a US individual who is taxable, right? So we're not speaking to pension funds, we're not speaking to sovereign wealth funds or endowments that are tax exempt, right? Those investors think differently. So when you are studying the market and trying to follow what the biggest and most sophisticated groups are doing, whether that is something like, the Harvard Endowment or Blackstone, or, pick your favorite, color and shape firm, right? That may not be right for you because they are operating under very different circumstances where their clients may not be taxed the same way as you. And so that's where things become much more nuanced because in our strategy, we're trying to make gross returns as close to net returns as possible because we're not just doing returns for the sake of it, for the scoreboard or just to brag to our friends. We're trying to make and keep as much money in our pocket as possible. And that requires focusing on the post-tax returns and the tax implications of all your investment activity. And that's where multifamily really jumps ahead. And I'm sure many of you already know this if you're, with us and you're on this webinar. So might be preaching to the choir here, but that's something that is unique and very, very different and should be evaluated. And actually, I was doing some research and I was actually looking at the REITs that are offered by some of the largest investment managers, whether it be like Starwood's REIT or Blackstone's REIT or Ares REIT. So these REITs are unique because this is a massive institutional company, but they're offering a product catered towards the individual, right? They're actually looking for $1,000 minimum investment, $5,000 minimum investment. And in those pitch decks, they're actually taking their distribution and they're building out a tax equivalent, basically saying if we're distributing 6% to you as a dividend, that has a tax equivalent dividend of 10% if you were to invest in, let's say, a credit vehicle or something else that is taxed at ordinary income rates and does not get the same benefits. Now, I'm not advocating investing in those REITs because I think there's other downsides and you're missing out on what some of the massive upsides associated with private real estate, namely depreciation and 1031 exchanges. But nevertheless, it shows you that that idea, that concept of post-tax returns is extremely relevant when catered to the right audience. So just because, the pension fund isn't worrying about it doesn't mean you shouldn't.
Yeah. And I think that's really where the alpha in real estate comes into play with the advantages that we have. And, obviously you mentioned, how, some of the depreciation benefit works, but also the 1031 exchange component to what we do is really the force multiplier that will allow people to really grow and scale their wealth, with sheltering and deferring a lot of the taxes and things of that nature.
Yeah, that's it's really it's not necessarily the most glamorous thing because people want to talk about the strategy and the high flying returns and the value add strategy and how they're buying something that's distressed and turning it into gold and whatnot. But really, the long-term way to make money in real estate is number one, not to lose it, and number two, to actually utilize the tax benefits. And people can utilize the tax benefits to varying degrees, and there's also quite a lot of misconceptions about what the tax advantages are, right? And so just to break that down a little bit, first of all, the majority of people are not going to qualify as real estate professionals for tax purposes, and that's perfectly fine. Without being a real estate professional for tax purposes, you still can use depreciation to offset other rental income. You just can't use it to offset your W-2 income. So, a doctor can't get depreciation from a real estate deal and then reduce their W-2 income. Now, a real estate professional can do that. They can take their depreciation and offset it against essentially all forms of income. And that is very, very powerful, but it's really not what we want to be advertising or promoting because majority of people simply can't take advantage. So what you can take advantage of is the basic depreciation, and whether you're a real estate professional or not, you can benefit from what we do and what many others do, which is a cost segregation study in order to elect 100% bonus depreciation, which was reinstated back in 2025. And the other thing I want to clear up is 100% bonus depreciation doesn't mean that you can actually then take 100% of what you invested as a loss. It doesn't that's not how that works, and that's not the correlation. What it does mean is that when you do a cost segregation report, or more specifically, when an engineer comes out and does the cost seg report for you, that engineer is dicing up the property into its individual components. So rather than viewing the property as a monolith and saying, okay, well, we're going to depreciate this property at, X schedule, 30-year schedule, for example, we're actually going to do a cost segregation and segregate each individual aspect of the property from the parking lot to the appliances to the flooring to the roofs, et cetera, et cetera. And by segregating, we're able to identify certain items that have shorter useful lives. Obviously, a fridge is not going to last as long as a roof, just generally speaking. And so what you're able to do is you're able to actually take the 5-year useful life property as well as the 15-year useful life property and sum all that together and say, okay, well, this is a $20 million property, but it actually has, let's say, $4 million worth of 5-year useful life property and 15-year useful life property. And then through the 100% bonus depreciation election, rather than depreciating those items respectively at the 5-year life and the 15-year life, you actually can just take all that, put it all together, and just depreciate it in your first year of ownership. And so that's actually what 100% bonus depreciation really means. And
This is the only segregation that I like.
and so this allows you to then, depending on how much debt you use, this allows you then to get somewhere around maybe let's say 40 to maybe 65% of the investment that you made into the property as a loss in the first year of the investment. And like I said, it matters based on how much debt you use because obviously the property, it's a fixed value property and therefore the depreciation that is being thrown off by the property is fixed as well. And so if you buy the property all cash, now that's a lot more equity that is being that is sharing that fixed number of depreciation. Conversely, if you use a lot of debt, now that's a whole lot less equity that is sharing that same pie of depreciation. So that's where people can get themselves into trouble because they can go chasing after deals that have more and more depreciation and maybe turn down a good deal because it doesn't offer as much depreciation, missing the fact that actually that's a feature, not a bug, that the property is throwing off less depreciation. And the reason why it's a feature is because the investment is being thoughtfully structured with actually less debt, more downside protection. And then here's another interesting fact or feature is that better investments, generally speaking, are in better locations. Better locations have lower volatility, which is another way of saying more downside protection.
Here's the interesting thing, though. I know you're getting to this, and I love this thought and concept.
Sure. So, yeah, you know already what I'm going to say, which is that when a property is in a better location, unfortunately, more of the property's value is ascribed to the land rather than to the physical improvements. And then you might say, well, what does that matter? Well, unfortunately, per the IRS tax code, land is not depreciable. They don't say that land goes down in value. And that makes sense. Land does not wear out. But physical improvements, things we talked about, the structure, the parking lots, the roof, those things do wear out over time. And that's the whole concept of depreciation. So you can depreciate the improvements, but not the land. So when you're in a good location, the land value is going to be creeping up and up and up on you. And that's less of the overall property's value that you can depreciate. So, like I said, don't worry about it. It's a feature, not a bug, because as Craig once famously said, the best way to get tax benefits out of an investment is actually just to lose the money, because
Yes.
then that's a full write-off. But we
Right.
don't want to do that here, right? We actually want to grow, we want to earn income along the way and grow the value of our investments over time, all the while receiving tax benefits. Everything needs to be put together in balance.
Depreciation, it's truly the cherry on top. It's not the sundae, it's not the ice cream, it's not the banana, the fudge, this, that. It's truly just the sprinkle and the icing on top that makes these things really sweet. I would say, in my estimation. And if you're seeking deals with a lot of depreciation, you might find yourself in a compromised spot, right? So I really want to highlight that once more that this is a massive benefit, but you mentioned a couple of things, which is, if you're a real estate professional, REAP status or not. What does that mean for our investors? Like, let's say Preserve a Copper Springs, right? As an example, if you invested $100,000 in that deal, we're projecting 60% bonus depreciation proportionally to that. So what does that mean? If you invested $1, you get 60 cents of depreciation. So can you explain to people how that works, scheduling out, assuming we hold it for the 5-year projection window and what that means for cash flow and stuff like that, please?
Yes. So I would say, like you said, and I said it, most people are not going to find themselves making that real estate professional tax election, and that's perfectly fine. That's not necessary to really get a ton of benefits from a long-term private real estate investing strategy. So with that being said, under normal circumstances, I would say the primary goal of depreciation is to shelter the entirety of the deal's distributions from being taxable. If you accomplish simply just that, I would say that's a win. Because as you know, our deals typically distribute somewhere around, 5% starting out and then build up over time, 6%, 7%. If things are really rocking and doing well, 8%, you know, uh, shout out to Preserve a Copperleaf, which we bought almost 2 years ago, which is going to be, sneak peek for everybody who's in that deal. It's going to be,
Very happy investor right here.
yes, we're going to be bumping up that distribution to 10% here come summertime. So that's going to be some summer good news. So, but at the end of the day, what we want is we want those distributions to be fully tax deferred. We don't want there to be a tax liability associated with the investment until sale. Because once you sell, you have to do a couple things. You have to face bonus depreciation recapture taxes, and you also have to face capital gains taxes. And this is important because you can actually buy a property, depreciate it, and then sell it and actually not make a gain upon sale, but you're going to actually owe taxes at the end of the day because of the fact that you took the depreciation up front and now you have to catch up essentially or recapture it. And so this is something that some people maybe don't fully understand, and that is understandable because this is complicated. But when you factor in those pieces, you understand the fact that depreciation is not a get out of jail free card. It's not a tax free thing, it is a tax deferral. And so the way that we make this tax deferral more powerful is by deferring for longer and longer periods of time. And that's what I talked about earlier is how do we bridge the gap from pre-tax return to post-tax return and try to make those numbers almost the same. And if you can do that over long periods of time, you're going to make a lot of money. And the way
So
that we do that, oh, go ahead.
Yeah, I was just going to ask a question. So let's say, for instance, this is the most updated underwriting for Preserve at Copper Springs here, right? So what I'm seeing here is that, if I invest $100,000, I'm going to have, roughly on projections about $34,000 of income. And then my equity is going to grow to ideally $171,000, right? Having said that, you mentioned that the deal, or we mentioned, I should say, that the deal offers 60 cents on the dollar in year one bonus depreciation and then smaller amounts after. So, can you speak to what this number looks like then? Is this taxable for everyone, or do you actually have maybe a delta or a carryover of losses there? Can you explain that to everyone in simple terms, please?
Yeah, that this is actually a really good point and makes it much more helpful. So, like we mentioned, this is a property that we just closed last month. We actually have, I think, maybe $300,000 left available. So if
It's
anyone's looking,
dwindling. So, if you are interested, come before it's too late.
yeah, just a quick plug there. It is a
We
506c
would ne
offering.
we would never ever self promote here.
No, no, this is no self-promotion. This is purely altruistic. But if you are interested,
But just saying, yeah.
please reach out. Go ahead and reach out to us. Go ahead and message Craig, Craig, at lscre.com.
First time
But
I ever said on this podcast.
enough of the commercial. So basically, like you mentioned, the estimate for year one depreciation, because we are electing bonus depreciation, is about 60% of the investment. So if we assume a $100,000 investment, as we're looking at here, then we'd assume a roughly $60,000 loss in year one, which would be 2026. So that'll be on the 2026 K1. And as you can see, we have a projected cash flow of about $4,400 in year one. And so those two things, I'm going to oversimplify a little bit. So the experts in the room, just hang in there, don't correct me. I'm just oversimplifying. But just to make it super simple, right? If there's $60,000 in losses in year one, well, we're only projecting to actually generate $4,400 in income in that year. So we
Based
actually,
upon a $100,000 dividend based on
correct.
that.
Right. So for the math whizzes, you can basically see that there's going to actually be plenty of depreciation left over because you only need about $4,400 of depreciation to wipe out that income. So year one income from this investment, year one distributions are not taxable. They are fully tax deferred by way of the depreciation. And on top of that, you're going to have about $56,000 of depreciation remaining that is going to carry forward for you. And so you can carry forward depreciation on a particular project for up to 15 years. So that's important to know. 15 years. And if you, so let's go to year two. Do you have $56,000 of depreciation left? And now you've got $6,000 of cash flow. So
So let's
again,
call it $10,000 roughly, or call it 11, just shy, call it 10,500 dollars now of income from this investment.
we can call it whatever you want.
Yeah.
So basically, there's going to be about, 60 divided by 10, there's going to be about $50,000 of depreciation left over. I think you guys are getting the picture now. Basically, if you don't use the depreciation for other means outside of the investment, just for the investment itself, you're still getting a benefit because you're still deferring the income associated with year one, year two, year three, year four, and even year five, because the total cash flow projected for this deal over a 5-year hold period is 34,000. So we have plenty of depreciation to actually carry forward and defer all that income. Now, someone smart would say, well, what happens if you don't sell in year five and you actually keep holding in year six, year seven, year eight? And that is a very fantastic question, and it's very important because if you do hold an investment for long enough, you actually will eventually start having taxable income associated from the investment because you effectively ran out of depreciation from the deal itself. Now, what's possible is you could actually have another investment in your portfolio that is throwing off depreciation, and you would be able to utilize that depreciation to defer the income associated with this investment if you were to have run out of depreciation from the investment itself. So it can be shared across different investments, but just focusing on a per deal basis, if you hold for long enough, you will run out of depreciation. And here's the trick, because some people don't like bonus depreciation because they don't, let's say, fully understand or like getting all that depreciation up front. But the reality is there's no downside because getting the depreciation up front doesn't cost you anything and it doesn't hurt you because you can simply roll it forward to the next period. And it's not like you're ending up with less depreciation in the end by taking it up front versus spreading it out or what have you. So that's a fundamental reason why, as much as I would love, absolutely love to hold property for forever, you actually shouldn't hold property forever if you're trying to optimize for not just pre-tax returns, but post-tax returns. And the reason being is because of the depreciation that we just covered there.
Yeah, some people like to do straight line depreciation, which is kind of the old standard way, which I believe is about 27.5 years of a shelf life on a property, equally gone throughout each year. We just have a different philosophy and we want to utilize the best of the best here. Because at one point, bonus depreciation was actually, in fact, sunsetting until the one big beautiful bill got passed.
Yeah. So then we're gonna wrap it up here because your sweet talk about the sundae and the cherry on top and everything just got me going on a sweet tooth. So I'm gonna have to go get a sundae now. But the real cherry on top is that we've got this depreciation going and we're carrying it forward and we're deferring all the income associated with the investment. But we have to be mindful of the hold period because we don't want to run out of depreciation and start creating taxable income for ourselves. So the solution there is to sell. But selling creates another tax problem because now you have capital gains tax and you have recapture. And the solution to that is, of course, as you all know, a 1031 exchange. And the magic of a 1031 exchange is that you not only are able to defer your capital gains tax associated with the previous deal and defer it into the next investment, you can actually roll over your depreciation recapture. So all the benefits associated with the depreciation from the original project, you don't actually have to settle that bill upon sale. You can, through 1031 exchange, roll that over and just continue deferring that depreciation. And then what makes it even better is that when you acquire the new property, you generate new depreciation all over again, and you're able to continue to defer the current income associated with your now chained process of deal after deal after deal. And so that effectively allows you to do that strategy that Craig was mentioning at the beginning as it relates to the stock market, where basically you're putting money away and you hold it forever. And why do you do that in the stock market? Well, because there's no 1031 exchange and because you can continue to grow and compound your equity in the stock market without facing tax consequence if you never sell. In real estate, it's quite similar, except you've got to do a little bit more maneuvering with depreciation 1031 exchange where you can really knock out the taxes and actually outperform because a 6% return in the stock market is miles worse than a 6% return in a multifamily syndication. And that's because of that pre-tax return getting closer and closer to that post-tax return.
Absolutely. Well, I think we've covered everything nicely on this session. We could perhaps revisit it later. If there's any questions that anyone wants us to answer, we welcome them all. And if there's any questions, maybe if you're watching a recording, if you want to comment on YouTube or email us, we will take any questions and would love to help and kind of provide our insights. Another thing just to note, my goal and philosophy, I'm not telling anyone what to do. This is just my belief and opinion, is there's probably going to be four buckets I ever want to put my dollars in. Okay, and I'll go through them real quick. Number one, we mentioned it, S&P 500-esque stuff, index funds, things of that nature. Number two, obviously my primary residence. I don't want to ever sell the house I'm in right now. The goal would be to make this a rental and then buy another house and kind of scale and stack that up. I think I have a unique ability to do that. And there's just some dollars I want to have myself that I have there that I personally essentially manage. Door number three is obvious, us LSCRE stuff. And then maybe down the line in the future, I would consider maybe some debt funds and debt investing. But I'm really feeling that right now is a uniquely great time for all the things mentioned to, if you've got debt positions there to maybe more short term to, look at the upside of the equity, especially when you factor, as Rob alluded to, the depreciation and how that's actually scheduled from a taxation perspective.
Wonderful. Well, thank you for that. And on that note, I think we can outro out.
All right, adios. Thank you so much for your time today. We will see you next week.